Hello and welcome to the webinar series presented by Alliant Retirement and Investment Services. Today, we're going to be talking AIM for your best financial life with a plan. My name is Joe Gaspari. I am one of the financial consultants with the Alliant Retirement and Investment Services team. We do these presentations nationwide, and we hope to work with our members on educating as much as we can on various topics. Today, again, this is highlighted, steps to take in your 20s and 30s. We understand there will be many different age groups listening to this presentation, but and this will pertain to everyone. But again, we'll talk a little bit about millennial age group and some of those types of that area. So we're going to dig into the presentation. Before I do get started, I do want to let you know that you do have some resources available. We have webinars that you can check up on our website to see various topics. We might be talking about Social Security one day, maybe Medicare, retirement planning, long-term care, various different topics at different times, different days, different times. It could be a noon or it could be early afternoon. It could be an evening. Hopefully there's something for your at your convenience that you can listen in on one of these, and we can take live questions and answers on those presentations. We do have a podcast that you can listen to, and our ARIS.Alliant Retirement and Investment Services, that's what the ARIS stands for, our website and blog. So today, the agenda, we're going to look at millennials and the need for financial planning, establish a budget and stick with it, manage credit cards, and becoming an investor. We'll talk a very general beginning for if you are not an investor already, looking to become an investor. We'll touch on that, and then taking full advantage of your workplace retirement plan, typically mostly a 401k, maybe a 403b if you work for maybe a school district or if you have a family member, school district, or maybe even a hospital, more nonprofit type of thing like that. So we'll touch on these topics. Number one, millennials and the need for financial planning. As we talk about millennials, that's the basically years born 1981 to 1996. We understand we might working with people older than that or potentially even younger than that. But 3.75 million millennials have student loan debt. Where it says here, I'm actually surprised it's not a little bit higher from numbers that I've heard and seen. 20 to 40,000 on average. I would have thought that would be a little bit higher. Homeownership rates lag behind Gen X and baby boomers. I understand the difficulty of purchasing a home right now with how expensive homes are now. My daughter and son-in-law had purchased about just over a year ago, and that was a tough process. Thankfully, they could qualify. They did have sufficient income, but getting into a home at more than asking prices was pretty typical in the Chicago area here, where you live. Maybe you had certain things like that too, or homes were just selling within a day or two, going over asking, and very difficult to get into a home with how expensive they are right now. Roughly a quarter of millennials believe they'll be forever renters with this situation. Interest rates are starting to come down now. Maybe you're aware of that, but the Federal Reserve very recently just lowered interest rates by 0.5 point. And that in turn brought down some mortgage rates are starting to decline again. So if you maybe are a homeowner now that you purchased in the last year or two at higher interest rates, refinancing will start to be a big topic as interest rates do start to decline, and hopefully people getting into a home with lower interest rates and being able to qualify now because of the higher payments with higher interest rates right now or over the last year or two. Less than half of millennials believe they're on track to hit their retirement savings goals. Enjoy the journey. Aim for your best financial life. Gain knowledge and experience. Help and guidance is always available from LPL. Now, where it says LPL, LPL Financial is our broker dealer here that we partner with at Alliant, with the Alliant Retirement and Investment Services team. LPL Financial, again, is our broker dealer. Very similar that if you were at a bank, like a Chase Bank, if you had an account at Chase Bank and you wanted to invest, you're not investing with Chase bank, you're actually investing with JP Morgan, if you weren't familiar with that. If you had an account at Bank of America, Bank of America will not do your investments, but Merrill Lynch will do your investments. Same thing at smaller banks and credit unions. We all partner with a broker dealer, and that is why you see LPL or LPL Financial. Topic number two, establish a budget and stick with it. Define your goals, knowing your income, and we're going to talk about net income versus your growth income when it comes to paying bills. Total your monthly expenses, create a realistic budget, and revisit and goals and expenses. Certainly something as I do a lot of retirement planning for people, and as we start to look at sometimes people I need to start saving more, and someone might say, what do I do? Sometimes we have to cut back on other things, and these things change as we get closer to goals, as maybe if you're looking at debt reduction as a credit card gets paid off, and maybe you're trying to, maybe put those payments towards something else to get maybe student loans or something else to get those down, but you need to keep revisiting your goals and your expenses. Defining your goals, examples of short-term goals, say for, in the short term, saving for a vacation, purchase the latest Apple Watch, or maybe the latest iPhone. I know my kids, which they still pay us, but we have still our family plan, and they keep upgrading their phones much more often than my wife and I do. Upgrading your furniture, saving for a wedding, and starting an emergency fund. And this is big. We partner with Susie Orman here at Alliant, and this is a big thing that we've had on getting people to start saving and having at least starting that emergency fund. Defining your goals, start when you start to narrow things down, buying a home if you're renting, and these might be the long-term goals now, paying off the student loan debt, starting a business, build up emergency fund to cover 3 to 6 months, not just starting the emergency fund. Now the long-term goal is to fund your emergency fund to try to get more time vested in that, in the 3 to 6 months of your expenses to be covered in that fund. Retire early. Some people have that long-term goal. I want to retire when I'm 50 or 55 or 60, or maybe something under a normal retirement age of, let's say, 65-ish or later. But retire early might be a plan. Make your goals measurable. Build up $1,000. Here's that starting that $1,000 emergency fund in, let's say, 10 months. Maybe someone let's save $100 a month. If we can just not do something else, the fun stuff maybe that we've been doing, we might need to maybe pause or cut back on some of those things and put $100 a month for the next 10 months and start to build up that emergency fund. Pay off a $3,000 credit card, maybe in 18 months, depending on your interest rate. As interest rates have gone up over the last couple of years, so I've heard some of these credit cards at, 20 plus, closer to 30% on interest rates on credit cards. That's a major pain in your budget. So it's certainly something that if you can start to fund a little bit more and maybe set a timeline for yourself on when you can get a credit card paid off. Contribute 8% to a company retirement plan. Maybe that's something that you're looking to as your percentage. If you do have a 401k at your job and you're contributing to that, if you say, all right, if I'm putting in 2%, maybe I should put in 5%. If I'm putting in 5%, can I stretch that up a little bit to start saving and giving and paying yourself first out of your paycheck in your 401k? You can increase your retirement contributions every year. Sometimes many 401k companies, for example, here at Alliant, we partner with our 401k is through Fidelity. And I can log in on my Fidelity site and say, I want to automatically increase my 401k contribution by 1% a year. So whatever, if I'm contributing 8% this year, it'll automatically do 9% next year, 10% the following year, and you're kind of forcing yourself. If you are in a position right now where you get annual raises, maybe that's where you say, well, if I have that extra, maybe I should put that right in my 401k and I can live on the same net income and still contribute more to your 401k. That's a very common thing that many people do. As they get raises, they increase the amount that they're contributing in a 401k. Knowing your income, your net pay, not just your gross pay. Everyone, you might talk, hey, I make 80,000 a year, I make 100,000 a year, or 50,000 a year. That might be your gross salary. But now we want to look at, after your medical that's coming out, after taxes, maybe your 401k contribution you're doing, what is your direct deposit, that we could start to look at your monthly bills and looking at your expenses, groceries, rent, utilities, entertainment. You're just going out to dinner. You can see everything listed here, but what's not on here? Maybe insurance. You have car insurance. Maybe you have renter's insurance. Maybe you have homeowner's insurance. Maybe you have life insurance. All these different things that you might have some other payments on. But again, if maybe student loans eventually will be paid off, and that money that can be more freed up for something else. But make sure you review your past bank and credit card statements, and just to see where is your money going. And back in the day, many, and I'll even say, my early married years, when we used to quote unquote balance the checkbook. And I know many younger people right now, like, I don't think I've ever even owned a checkbook, let alone document everything. Everything was paid by a check years and years ago, and you kind of knew what was in your account. If you wrote $100 check, you put a minus 100 and you put a new balance in your checkbook. So you kind of knew where you were. Now with debit cards, and people don't even know what their checking account balance is. They just know there's something in there and I have enough. If I hand a card to a retailer, that will go through, but you don't even know sometimes what you're even paying. You're purchasing something and you swipe the card or hand the card before you even look at the total. And so that's certainly something that we need to be aware of if we're looking at budgets. Creating a realistic budget. Here's an example of monthly income from step 2, and that was just looking at what's going out. So 3,750, or actually what's coming in, and monthly living expenses, and that was from step 3, and that's all of your rent and maybe your student loans and your credit card payments and all those payments going out. Your monthly financial goals, maybe you're saving for the vacation or saving for something or a down payment on a home. You're funding your emergency fund, and then you have a little bit left over. But again, this is just looking at a realistic budget of what's coming in and what's going out. Where are you allocating your funds? Step 5, revisit your goals and expenses, prioritize your expenses, rework your time frame, and increase your income. Easier said than done, maybe on the increase your income, but there's always sometimes, when we were younger, if you had the 2 jobs, if, or husband and wife both working, if you have children, trying to work around who's watching the kids while one person's working. My wife used to waitress around my hours. I'm going back several years. My kids are in their 30s now, so it's certainly something years ago, but we had to do what we needed to do to get the income and not going broke on daycare. We kind of worked around each other's hours. Building an emergency fund. Accumulate 3 to 6 months of living expenses. Keeping the money liquid. Basically, you need those funds available, accessible. Use the funds when needed and not a credit card. We're going to touch on credit card use here very shortly, but it's something that if you can pay for it, not charge it, because if you are in that habit of, I could pay it off, but I'll just maybe make the minimum payment so I can have those funds for something else fun. But maybe that answer is pay for it instead of putting it on a credit card. So manage credit cards wisely. Review your statements regularly to keep your purchases in check. And again, if you had the checkbook, that was easier years ago, but keep an eye on your balances. Pay your bill on time to avoid any late charges. Paying off your full balance every month to avoid interest payments, especially if you are that 20 plus interest rate. Take advantage of reward programs. And I know if responsible, if you can buy something, if you are going to buy something anyway and use the card, maybe you get the points or the miles or whatever your reward program is. But again, doing it very, respectfully and doing the right thing. Protect yourself against credit card fraud by putting a freeze on your credit bureau records. Very common these days, as I have that on my credit report. My wife has it on hers. And the biggest thing is when you get the letter from, maybe you purchased a ticket on Ticketmaster in this last year or two. If you did, maybe you received a letter from them, is that basically they were hacked. People got into your information might be out there. If you purchase something, maybe there's your credit card information is out there. And this has happened. Look at Target, many other retailers that have had credit card or their systems broken into, and maybe your information is attached to something there. So you always want to be very aware of what's going on with your credit. And does someone have your information, and are they opening accounts? So you want to be very cautious of that. 6 bad habits to avoid: using your card to make ends meet. If you're trying to pay your bills, your general bills on a credit card, and that balance keeps increasing every month, hopefully you can avoid that. Using several credit cards at one time. When you've seen the movies or something and someone goes to buy something and they hand a credit card, that was declined, so I'll just hand another credit card. Maybe that was declined, and hand a third credit card, and oh, finally that one went through. But it's just so out of control on some of those that, if it's something that can be avoided, yes, please do. Not researching other options before applying for credit cards. Exceeding 25% of your credit line, and this affects your credit score. If you're not familiar how your credit scores work, which again, we're going to touch on a little bit more here, but your credit score goes based on your payment history, number one, and your available credit. So your available credit, so if you have a $5,000 credit card and you have a balance of $4,999, you have that $1 available. Basically, your 99.8% of your credit card balance is used up. You have no credit available. That could be a negative on your credit score. So if you have a $5,000 credit card and there was $500 on there, but you paid it off, and then you put another $800 the next month, but paid it off, and you're showing that you have credit available, you're paying your balance off, you're not paying interest every month. It's certainly that once your credit card balance gets too high, it could certainly affect your credit score. Using rewards programs and as an excuse to buy more items, more things that you just say, well, I need more miles, I need more points, I want to go on a vacation soon, and I would love to buy my ticket with miles. And you can certainly potentially do that, but you're just going to buy something just to get the miles. Hopefully you can avoid that. Making large purchases unless you can pay off the balance quickly. Maintain a favorable credit history. Know your FICO score. So these are the credit bureaus. You see Experian, TransUnion, and Equifax. Many people are aware of these. If you've ever went to purchase a home, purchase a car, try to get a credit card, anything that you applied for some type of loan, the lender is going to check your credit through one or all of these credit bureaus. And your FICO score, in this case, what they're explaining is that it's kind of a combination of all three of these. One lender might just pull from TransUnion, one might just pull from Experian or Equifax, but this is basically a combination. And when you look at on the right side of the screen where it says lenders generally regard scores of 670 plus as a good credit risk, be aware that if you want a mortgage and you want the best interest rates, there are lenders out there that I've spoken to that if your credit score needs to be 740, 760 plus to get the best interest rates. on a mortgage. So lenders back in, I did mortgages before I was in a financial consultant, since I've been in this business for a little over 20 years. But before that, I did lending. I was with a mortgage firm and back then you could have a 620 credit score and qualify for the best mortgage rates. Very different these days. So you'll always want to know kind of where your credit score is. Having a lower core score can keep you from qualifying for a mortgage or a car loan. Potential employers, my employer, even LPL Financial, the broker dealer that I am licensed through in what I do, I have to have good credit for that. And LPL Financial will spot check my credit. And I always have to have a clean credit history. The better your credit score, the more likely you are to have your loan approved and receive lower interest rates. Tactical tip, improving your credit score. Make payments automatic to avoid any late fees. Even if you're 1 day late, it could be maybe a credit bureau or a creditor might report you as 30 days late. That's usually if you pay it late, but before 30 days. Many lenders may not report you to a credit bureau that you were late, but if you were 30 days or more, then that could show up on your credit report. If you're 60 days, that's even more of a ding on your credit, 90 days plus. Charge-offs, any collections. If you had a parking ticket that wasn't paid in the past, a municipality can put that on your credit report that you have an unpaid collection, and that could affect your credit score. So you want to be very conscious of what things you've paid. Do you owe anyone anything? Make sure your payments are on time, or if it's something like a parking ticket or any little ding like that, you want to definitely make sure that those are paid and so they do not go to a collector. Become an investor. If you are working and you have a 401k, that's certainly one of the most popular that we'll touch on here. But when to take the plunge as being an investor? When you have steady income. Sounds obvious, but it is important. When you have steady income and you can say, I can start to put money for long-term investing. Now we're talking about stocks and bonds and mutual funds and different long-term things like that. It's certainly something that will help you in the long run, saving for retirement, saving for the long-term goals. If you have money left over after meeting you're paying your bills, if there's leftover, maybe you can start investing. You've considered the effect of upcoming personal changes, such as a marriage, children, or divorce before investing. You've built up your savings, including a 3 to 6 month emergency fund. I would highly recommend if you said, I have $1,000 in my account, I want you to keep that liquid in your account. And maybe after you've built up more of an emergency fund for 3 to 6 months, then start investing. Stocks or stock mutual funds and ETFs. ETFs are what are called exchange traded funds. It's very similar to like a mutual fund, but this is basically in the stock market. You are investing in stocks now. It's ownership in an issuing corporation. So for example, if you bought Apple stock, you are a quote unquote part owner of Apple. You have ownership in there. If you are investing in a company that pays dividends, now based on the amount of shares that you own of that, you start to get a paycheck every month or a quarter, you typically on dividends. They are bought and sold on a stock exchange like the New York Stock Exchange or on the NASDAQ. So basically you can buy foreign stocks as well, but it's bought and sold on stock exchanges. It's higher potential return. You can get a big reward, but you are taking on higher risk to do this. Used to fund long-term financial goals, not appropriate for short-term financial goals. because of the volatility, potential volatility, and the fluctuations of the stock market. I've had people say, I had one person years ago said, I have 100,000 I'd like to invest. I just want to earn more than I can get in my savings. Well, what's this money for? Is this for anything in particular? And he said, yeah, I'm buying a house next year. The last thing I would want is that 100,000 to go down to potentially 80,000 because of a downturn in the stock market. And there goes his down payment. So my recommendation for that short of a term is to probably not invest in the stock market. And I know some people have still for short term, but again, I don't know if I would want to recommend someone investing in something like that with the volatility and the potential for losses for that short of a time period. Bonds and bond mutual funds used to finance projects or operations of companies, municipalities, states, and sovereign governments. You loan, not own. A bond, if you are not familiar, a bond is a debt. So for example, if you bought a government bond, a US government bond, and those could be very short term for a 1 month loan or 2 month or 3 months or 6 month or even 5 or 10 or 20 or 30 years. So our government will borrow money. When you buy a government bond, you are lending the government money. If you bought a municipal bond, you are lending a municipality money, maybe a city, maybe a hospital, an airport. You are lending money to someone, and in return, you would hopefully get an interest rate, a decent interest rate at the end of that loan, which it could be a 5-year, could be a 10-year bond that you're buying. You would get this interest rate. Let's say it's a 10-year bond. You would get that interest for 10 years. At the end of 10 years, you get your principal back, hopefully. But now you're looking at what is the financial state of whoever you are lending to, the government or a corporate bond or a municipal bond, whoever you're lending this money to. You just want to make sure that they're a good, sound company and they have those funds to pay you back when that loan comes due. And this happens very common. Stock and bond market, our government borrows money all the time. Look at what are we at now, 35-ish trillion dollars or more of our debt in this country. And we keep borrowing money and those interest rates are a little higher now. So again, when you buy a bond, you loan, not own. You're not part ownership in anything. You're just lending your money. A moderate return potential with moderate risk, appropriate for funding medium-term goals. And this is typically maybe not your long-term, but not short-term again. May make up a bigger part of your portfolio at or during retirement. So as people want to back off a little on risk, maybe lowering the amount of stocks that they own, which could be more volatile, maybe they would own more bonds as they get closer to retirement. As we look at cash equivalents, typically money markets, savings accounts, CDs, U.S. Treasury bills, which are those 1 month, 2 month, 3 month, 6 month treasuries or bonds that are available. Lower return potential, but with lower risk. Right now, some of these bonds are paying, if you bought a very short-term treasury, you're getting in the mid to upper fours right now, the 4.5 to 4.8% return in some very short-term treasuries, maybe some money markets, which were over 5%. As the Fed just lowered rates, those rates will start to tick down a little bit. Maybe you're still enjoying a 5+% interest rate on a money market at some of the online banks out there, but just be cautious that those interest rates can come down. Appropriate for shorter term goals and make up a part of the portfolio at or during retirement as people want to back off on risk. So again, these cash equivalents, much more attractive now with higher rates, but as rates start to go down, I don't know if we'll go back down to where we were pre-COVID when or actually during COVID when interest rates went down and you were getting at a big bank like a Chase or a Bank of America or a Citi, or when you're getting 0.01 or 0.02 in a savings, and interest rates were extremely low. We were as low here at Alliant, as low as 0.5% on a savings. Now, of course, much higher than that. But again, are those rates going to go down? I just don't know yet. Diversifying your investments. A foundational element of investing helps manage risk while seeking to maximize. If, again, very important to diversify, not all your eggs in one basket. Uh, Need help getting started here at Alliant Retirement and Investment Services? This is what we do. We do investing for our members. Once you become a client of Alliant Retirement and Investment Services, and we're investing funds for you for the short term or for long term, you can, number one, understand different types of investments and their place in the balanced investment portfolio. Determine your financial goals. Are you more risky? Are you more conservative? Is this money short term? Is this money long term? Determine an appropriate investment strategy for your financial goals based on your risk tolerance and time frame. And you could discuss professionally managed investment strategies that may be of interest to you and track your progress by meeting. We would track your progress by meeting with you on a regular basis. If some people want to, I talk to monthly, some people might just talk quarterly or every 6 months or 1 year. Some are more active than others on these. But again, whatever your wants or needs are on how often you would like to talk about these accounts, we would do that. Taking full advantage of your workplace retirement plan. Benefits of your workplace retirement plan, easier way to become an investor. And again, typically your 401k, maybe a 403b. If teachers, school districts, or hospitals would do a 403b. Biggest and best opportunity to achieve your financial wellness for most people. Many people, this is how many people save more, is in their 401k. The benefits of your workplace retirement plan: your savings are automatic, just comes out of your paycheck. Your taxes are reduced and tax deferred compounding. What this means, looking at the right side of this page, if you had a 50,000 salary and you were putting 10% in your 401k, that is 5,000. You are taxed on 45,000. So that 401k contribution comes off the top, then you are taxed. That is called pre-tax money. So your 401k is funded, your regular 401k is funded pre-tax, and that is like a deduction. And so you're putting in this $5,000 annual contribution. If you happen to be maybe in the 22% tax rate, and that is an $1,100 tax savings for that year. Now, you got to pay those taxes later when you are in retirement, let's say, and you want to start drawing from those accounts. Maybe you're going to be at a lower tax bracket in retirement. Now we're talking about that you do have to pay those taxes when you start to take money out. So that money comes out of your paycheck before you pay taxes. So you are never taxed on that money. And it grows over time, and you're adding to it, and it's growing, and you're adding to it, hopefully growing. Then you are not paying any taxes on that. So over all the years, your working years, as that money is growing, you haven't paid a dime of taxes. But then once you start to draw from that, you do have to pay those taxes. So benefits of the 401k or workplace retirement plan: free money courtesy of your employer match. If your company does offer a match on your 401k contribution, you have to put in to get that match. So if your company is matching, let's say 3%, you have to put in 3% to get 3%. But basically, you double your money day one. If you only put in 2% of your paycheck, they will only give you 2%. If you put in 5% of your paycheck, they will give you 3, if it's a match of up to 3% in that example. Your money goes where you go. So if you, let's say you left an employer to go to a new employer, you can move those 401k funds potentially to the new employer, or you can even roll it over to a traditional IRA, which is the equivalent of your group retirement plan, is the 401k. Or if you left that and you wanted to take control of those funds, you can roll it over to a traditional IRA. IRA meaning individual retirement account. So you can manage that yourself then, or through someone like us that we can open up an IRA for you. Account management made easy in your 401k. Traditional versus Roth. So this is traditional is your pre-tax. Remember, it comes out before you pay taxes, but the tax benefit is now. So you're paying less taxes when you're contributing. If you happen to have a Roth 401k available, then you actually, let's go back to that $5,000 paycheck. If you had $5,000 paycheck and you wanted to put 10% in a Roth, I'm sorry, go back to that 50,000 a year. So if you had 50,000 a year income and you put 10% into your Roth 401k, that is 5,000, but you get your paycheck first, you pay taxes on that, then you get a net paycheck, then you make your 401k your Roth 401k contribution after tax. So it's after tax contributions. But the good part is as that money grows and you're adding to this, maybe every paycheck or every year, you're putting into this Roth, it's all tax free coming out. So all the interest or growth that you make on it is tax free. So do you want the benefit now or do you want the benefit later? Or maybe you can even split that and do, if you said, I'm going to put 10% in my 401k and I'll put 5% in the traditional and I'll put 5% in the Roth. Maybe you can do both. And that's certainly a very common thing that some people may do. So Roth option may be a more favorable strategy for younger adults as that money will grow over the years. And hopefully the younger you are, the more growth that you will get over more years, then it's all tax-free down the road. Consider diversifying your contributions between both options. Target date funds, a typical a type of mutual fund, assumes investors need to begin withdrawing at a specific time. An example here, Retirement Fund 2055. Many 401ks, or just about every 401k that I've seen people investing in, has these target date funds. And it's kind of the almost a default of many 401ks that if you say, I don't know what to invest in. I have different stock funds and different bond funds to pick from. I'm not sure what I should do. Basically, a target date retirement fund would basically invest you in something you're closest to your age 65. So if you were 40 years old now and you're going to be 65 in 25 years, so we're in 2024, so 34, 44, so close to the 2050 fund, you would be the closest to your age 65. So if you are 40 years old, maybe the recommendation or the default might be just invest in the 2050 fund. If you were 35 years old, you would invest in the 2055 fund because that's when you'd be closest to your age 65. Again, that's just a default, or if you're not sure what to do, or start to dig into just different individual funds that you have available within your 401k. But these are very common. Professional fund manager oversees the fund and adjusts the risk level over time. Individual retirement accounts, IRAs. Again, we talked about rolling over to a traditional IRA for that 401k, certainly an option, but an individual retirement account typically used by self-employed individuals who don't have a 401k available. Maybe they might invest in an IRA and make IRA contributions each year instead of a 401k. Accounts held by a custodian, such as a bank or brokerage firm. We have traditional or Roth IRA accounts here at Alliant Credit Union in the credit union side, and even on the investment side of LPL Financial, our broker dealer. We also do traditional and Roth IRAs and investment accounts as well. Much larger universe of mutual funds to choose from. When you have your 401k and you have your list of options available, hopefully you are contributing to a 401k. You've at least seen these where you have different stock funds to pick from or different bond funds to pick from or all those target date funds. And you might have a list of 10, 20, plus, funds. There is a world of investment options out there in a traditional IRA. If you want to invest in individual stocks, you can in an IRA. You just have more options available. So contributions are generally tax deductible in a traditional IRA. Earnings are tax deferred, and withdrawals, again, same as that 401k, withdrawals are taxed when you start to take out of that. So again, you get the tax benefit by putting in traditional IRA, but you have to pay the taxes later. There are also Roth IRA options available, which you put in after-tax money, but then it grows tax-free. Hopefully, if you do want to have a one-on-one conversation with one of us, one of our financial consultants here at Alliant Retirement and Investment Services, we can dig a little deeper if you need to on, all right, I need to know a little bit more about the difference between a traditional and a Roth IRA. We can certainly do that for you. Execute essential legal documents, a will, a living will with advance directive, maybe someone that says, I would like to have a do not resuscitate or something if I'm have a serious medical issue and you're going to go, I don't want extra measures being taken. Maybe someone says CPR okay, but I don't want to be intubated or something like that. You can put those in an advance directive. Medical or healthcare power of attorney. If you are a single person or if you have a spouse, having power of attorney documents, which we have, between me and my wife, that if something happens to me, she is my medical and financial power of attorney, that she can act on anything that is just in my name financially, like a 401k or a traditional IRA. That those you can't have joint 401ks or IRAs. So she can have access to those if I'm in the hospital or incapacitated. I have a trusted person that that can have access to something. We're joint on our savings and checking accounts. But having that, if I was in a coma or I'm in the hospital, is someone available to sign off on something? Maybe you're a single person. Do you have a parent or a sibling or a good friend that could be a medical or healthcare, or medical health or financial power of attorney to act on your behalf if you are not able to? Very important documents to have. Review insurance coverage. This is something actually I'm going through on property casualty. We just changed to a new car, one of our cars, and so the insurance went up. So maybe it's time to shop and see what else is out there. So it's certainly something that we look at periodically. Life insurance, if you are younger and maybe you're starting a family, what if something happened to you or maybe a spouse, and can the survivor still go on, maybe with children, and still get to pay the bills? Obviously, life changes, and that's a big step for this. Obviously, if someone passes away, but that survivor, the world just changed, both emotionally and financially, and certain things need to be in place. Life insurance might be something to look at. Disability insurance, that many employers might offer disability insurance through, out of in your benefits. Certainly something to consider, that if you are disabled, can you still pay your bills? So your LPL financial professional can help here at Alliant Retirement and Investment Services. We'd love to work with you. Determine your savings goals, how to achieve them, decide between Roth versus traditional 401k or IRAs. Create your investment strategy and monitor it. Balance retirement with your other financial goals. Thank you so much for your time and attention. We hope to work with or speak to you soon. Here's a little bit of a disclosure that through this presentation, this is not we are not recommending certain investment strategies or stocks or bonds or mutual funds. This is purely educational. But if you would like to have that one-on-one conversation to get more advice specifically for you, now we can talk about recommendations at that time. But again, this presentation is just strictly for educational purposes. And here's again a look at some of the resources that you have available. And we hope that you'll check these out, and we'll hopefully see you on some webinars in the future, or that you'll be listening to the podcast or at least checking out our website.